Hi everyone, and welcome to the fourth day of practice to pass sessions for financial management. Let us wait for a couple of minutes for others to join, and then we will start our session form. Guys, can you hear me? Okay, I guess the network got disconnected in between. So welcome back. So in this question, what are we supposed to be calculating? We are supposed to be calculating weighted average cost of capital. And let us go through the question. The balance sheet of the Corey and Orr company is as follows: non-current assets, and we have long-term liabilities, irredeemable loan notes, equity, retained earnings. Okay. Um, Equity shares have a current market value of 90 cents, and annual dividends are expected to remain at 18 cents in perpetuity. The loan notes has a current market value of 71.43 per $100 nominal value, and the rate of tax is 35%. The company includes its current liabilities, a bank borrowing facility at a variable interest rate, which is renewed every 6 months. It can be assumed that $10 million of this borrowing is needed on a permanent basis by the company. The interest rate currently being charged for borrowing under this facility is 16% per annum. And okay, now we have to calculate the weighted average cost of capital. So how many sources of finance do we have in this question? So in a weighted average cost of capital question, this is a very important thing to identify, that how many sources do we have, because we have to calculate the weighted average of these sources. Yeah, we have got three sources, right? We have equity, which is always the case. We have a long-term irredeemable loan notes, and the third one, which they're saying that we need it on a permanent basis, is a short-term facility, which has a cost of capital of 16%. Oh, sorry, cost of debt of no, it's the interest rate, which is 16%. So let us firstly see if we have uh, the cost of all these three sources of finance. First of all, let us calculate the cost of equity. And cost of equity will be calculated using dividend valuation model. The current market price is 90 cents, and the annual dividends are expected to remain at 18 cents in perpetuity, which means that they do not expect any growth in the dividends. So it will be a very simple thing to calculate the cost of equity. It will be the dividends, which is 18 cents, divided by 90 cents, because the share price is 90. So it's 20%. The cost of equity is 20%. Okay, then we have to calculate cost of debt of the loan notes. Uh, the interest rate on loan notes is 10%. 10%, and the loan note has a current market value of 71.43 per 100 nominal value. Now, there is nothing mentioned about whether the loan note is redeemable or irredeemable. So what do we need to suppose? What should we suppose? What should we be assuming? Okay, in case uh, they haven't mentioned anything about the redemption, the normal assumption should always be that the loan notes or whatever the debenture is, it is irredeemable. But in this case, it is mentioned the 10% irredeemable loan notes, right? But in case they don't mention whether the loan notes are redeemable or irredeemable, then the normal assumption is always to assume irredeemable. And for irredeemable, it is very simple to calculate cost of debt. First of all, pick up the interest rate. It's 10%. Multiply by the par value, which is $100, and then multiply it by the 1 minus tax rate. Multiply it by 1 minus the tax rate, because interest is always tax allowable expenditure, so we have to subtract tax from it, which is 35% in this case. So 1 minus 35%. So if we do this, it will give us a value of $6.5, right? That's $6.5, which means against $100 of loan note, this is the amount of interest that investor will be getting after tax. Now we have to convert this into a percentage. That is, we want to find out the rate of return on investment. Now the value of this $100 bond or loan note is $71.43. So it means currently the investors are getting $6.5 against the investment of $71.43. So in order to convert it into percentage, we have to divide it by the current market value of this loan note, divided by 71.43. So if we divide this after tax amount of interest by the market value, we'll get the cost of debt, which is approximately 9.1%. The other names that we can call this with will be IRR. We can call it IRR, or we can call it interest yield, right? This is interest yield. So either we call it cost of debt, or we call it IRR, or we call it interest yield. They can be interchangeably used. Then it's the bank loan, the short-term loan, which has the interest rate of 16%. 16%. Since bank loan is not tradable, so we don't need to divide it by the market value. So 16% itself is a cost of debt, but it's a before tax cost of debt, so we have to multiply it by 1 minus 35% to make it after tax. So 10.4% is the bank loan's cost of debt. So there are 3 sources for the company, and we have calculated cost of each of the sources. Now comes the time when we have to convert it into the weighted average cost of capital. For that, we need values. We need values of these sources. Now, when it comes to values, we will either be picking up market values, or we will be picking up book values of these sources. Now, we usually don't have the choice. It is always the question that will mention which values should be used. In case there is nothing mentioned about which values to be used, usually it should be the market values, right? Usually it should be the market values. As far as possible, we should be using market values. But in case we don't have any information related to market values of these debts, then helplessly we have to use book values. So let us first see if there is anything mentioned regarding whether we should be using market values or book values. I guess nothing is mentioned about it. They've simply asked us to calculate the current weighted average cost of capital. So market values should be used. It's better to use market values. So let us calculate market values of these sources. First of all, let's talk about equity, and the price of each share is 90 cents. Now, how many shares do we have? That's the total par value, the total par value of the shares. So in order to calculate the number of shares, we have to divide this value by the per share par value, which is $0.5 in this case. So always remember, from the balance sheet, they give us the total par value of equity share capital, and by dividing it by the per share par value, we will get the number of shares outstanding. So in order to calculate total value, we have to pick 20,000 divided by 0.5 and then multiplied by the market price per share, which is 90 cents. So 90 cents would mean $0.9. So 36,000. And since you know that these values are in thousands, so we have to mention the same at the top. So is that clear? Musawir, the KD of the loan notes, it's a simple one. Just pick up the coupon rate, the interest rate, multiply it with the par value in order to find out how much interest will be paid, and then multiply it by 1 minus tax rate, so that we should make it after tax, and divide it by the market value. There is no need to deduct dividend from the price, because that's only done when we have cum div price. In this case, they haven't mentioned whether it's ex div or cum div, so the usual assumption is that it is already ex div, so we don't need to subtract. Okay, I hope you people have understood how we have calculated the market value for equity. Okay, similarly, we have to calculate the market value of loan notes. For that, again, we have to go to the balance sheet and see what was the total book value of the redeemable notes. It's 28,000, and the current market price is 71.43. So firstly, we have to write 28,000 value and divide it by the par value of each loan note, which is $100, and multiply it by 71.43. So it's 20,000 approximately. Whereas the bank loan was, I guess, $10 million. Yeah, $10 million. So we should write 10,000. So these are the market values, and since bank loan is not tradable, so the book value will be used. Now, how do we calculate weighted average cost of capital? Let's first see how much we are paying in terms of dollars to our investors. So we're paying 20% to our investors against their investment of $36,000. So how much it will be in terms of dollars? 20% into 36,000. This is the annual amount that we will be paying. 7,200. Then 9.1% into 20,000, 1820. 10,000 into 10.4%, 1040. So the total that we will be paying our investors in dollar terms will be 10,060, 10060. That's what we would be paying to our investors against their total investment of 36,000 plus 20,000 plus 10,000. So if you want to find out the WACC, weighted average cost of capital, it's simply the amount that we will be paying to our investors in dollars divided by the total value of their investment, which is $66,000. So the weighted average cost of capital will be 15%. If we write it up to 2 decimal places, it's 15.24%. So let's see if we have the option. It's a fill in the blank, I guess. It's a fill in the blank. So that's our answer. Is that clear? Mahin, for bank loan, we don't need to calculate the market value because it's not a tradable debt. Therefore, the value of the face value or the loan, the book value is what should be used. Musavir, I'm coming back to your question. First of all, let me answer the previous questions. So can you please explain how, so I have shown the cost of equity now. Can you please go to cell CS79? S79, yeah, that's it. Then Akash has asked me a question, sir. In 28,000, that 10 million is included or excluded? No, it's not included in the 28,000. It's clearly mentioned that 28,000 is your irredeemable loan notes. They have mentioned that the $10 million of bank loan is shown in the current liability. On the balance sheet, they haven't shown us current liabilities. They have shown net current assets. That means they have already deducted current liabilities from the current assets. That's why nowhere this 10 million has been mentioned on the balance sheet. Okay, now comes those Musavir's question. Musavir's question is, sir, which method is acceptable of KD in exam? So Hussain Kazi told us to calculate by IRR method. Musavir, in case you have a debt that is redeemable, right? And redeemable at a different value than its market value. These are the two conditions. Firstly, it should be a redeemable debt. Secondly, the value of redemption should be different from the market value of the debt. So if the market value and the redemption values, they are different from each other, number one, and the loan note is redeemable, only in that case we use that IRR method. In case the loan note is irredeemable, even if you use that IRR method, that lengthy method, you will get the same answer at the end. So there is no point of going through a long process if you can achieve the same goal through a short process. I hope it's clear. Musawwir, is it clear? Thank you. So can you please show how you got cost of equity of 20%? It's just the dividend divided by the market price, as there was no growth. The dividend divided by the market price. Should I move to the next question? Okay. Here we go. It's a two companies are identical in every respect except for their capital structure. XY has a debt to equity ratio of 1:3 and its equity beta has a value of 1.3. PQ has a debt to equity ratio of 2:3 Tax on profit is at 30%. Estimate beta value for PQ is equity. Okay. Firstly, who's going to tell me what is equity beta? What does it show? What does equity beta show? Okay, great, great. So what if equity beta of a company is 1.5? What does this tell us? What does this tell us? 1.5. If a company has an equity beta of 1.5, what does this tell us? If you have to interpret this 1.5, how will you do that? Yeah, Zainab, you are spot on. It means that the company is 1.5 times as riskier as the market is. What does that mean? If you have to further explain it, what does that mean? That means if you if you are gauging if you are gauging the risk of a company from its value, right? That is the share price, let's say. Now, if if a company has a 1.5 times of equity beta, it means if the value of share, let's say on average, if in the market the value of share increases by say 10%, that's the average increase in the market in the share price. This particular company's share will increase by 15%. That is 1.5 times of what increase other companies have shown. So its increase in share price will be 1.5 times that of the market. Similarly, if the share price in the market goes down by 10%, this company's share price will go down by 15%, 1.5 times. That's what it means. Similarly, you may gauge this risk through the return that shares generate. Say, for example, the average return of the market goes up by 10%. This company's return will go up by 15%. That is 1.5 times of the market. This is what does it mean? 1.5 times. Now, if a company is perceived to be 1.5 times as riskier as the market is, obviously the investors will be asking for more risk premium than they ask from the average market. So if the average market is giving 8% risk premium, that is, it is giving 8% additional return for the risk that the investors are taking. What do you think? How much risk premium will the investors expect from this company if the average market is giving 8% risk premium? How much risk premium investors will expect from this company if it has equity beta of 1.5? Yeah, yeah, exactly. Because the market is giving us 8% return, and this company is 1.5 times as risky as the market is. So the investors will be expecting a return of 12% from this company, 1.5 times of the risk premium, right? But that's not the overall return. That's just the return against the risk. And there is always a risk-free return. Say, for example, the risk-free return is 5%. Which means that the investors are going to get 5% irrespective of where they invest. That's a risk-free return. That's something that they will get even if there is no risk. And they will ask 12% return from this particular company because of risk. 5% they're going to get anyways. So the total return that they expect from this company will be the risk-free return and the risk premium, that means 17%. So the total return expected from this company based on the risk level of 1.5 times will be 17%, and that's called CAPM model. We've calculated this expected return on equity for this particular company using the CAPM model, which is, let's just for the sake of your revision, when you use CAPM model for calculating equity beta, it is equal to risk-free return plus equity beta multiplied by market risk premium, which is equal to market return, that is the overall return the market is giving, minus the risk-free return. The difference of these two values is basically the market premium. So risk-free return, this is something that every investor expects to get, even if they're investing in a risk-free security. Apart from that, they are also going to get some premium against the risk that they are taking. Okay, I hope equity beta is clear now. So let us do some working for this question. It says that we have to estimate equity beta for PQ company. Now there is a concept involved in this, and first let me explain that concept before we solve this question. When we say risk, there are two types of risks. One risk is the systematic risk, and the other is the unsystematic risk. And the other is unsystematic risk. Systematic risk is a risk that is faced by every company in a market. In a market, this is the risk which every company faces operating in a particular market. Like for example, if you are in an automobile sector or industry, the company is operating in automobile industry, and all the companies in that automobile industry, they import cars and they sell them, right? Every company in that market operates in this way. Now the risk that a government may impose import duties, which will in return increase the cost of a car, that is a risk which will be faced by every company in that market, as it's not going to affect a single company. It will be affecting all the companies in the market, because every company in that market is operating in the same way. That's called market risk, or we call it systematic risk. On the other hand, if one of the companies is dealing in antique cars, right? They've taken a decision that they need to have a division that deals in antique cars, old cars, heritage cars. So they're dealing in those cars. Now, if the market for antique cars goes down, the demand goes down, no other company will be affected except for this particular company, because that's the decision of that particular company. So anything goes wrong with the antique cars will be affecting this company and not any other company. That's called unsystematic risk, or we call it company specific risk, because this is not going to affect any other company in the market. Now, if I'm an investor and I'm investing in this particular company, I will know that there is an additional risk with this company, with that antique car. It may be profitable, it may go at loss. This decision may go at loss as well. Now, in order to reduce my risk, I may invest in other companies as well. So in case I lose from this company, I may gain from the other company. So in this way, I can reduce my risk, and this is called diversification of risk. So I can diversify this unsystematic risk by investing in other companies as well. So an investor, by his own planning, can reduce the unsystematic risk by maintaining a balanced portfolio of investment. So usually they do not expect return or premium against this type of risk because they can easily diversify this risk by maintaining a balanced portfolio. But since every investor knows whatever they do, in whatever company they invest, they will have to face a systematic risk. So they will only be willing to invest in this market if they get premium against this systematic risk, because they know that they cannot diversify this risk as this risk is there for every company. So the equity beta that we talk about, equity beta, that 1.5 times. So the investors who expect premium from against this risk, that premium is calculated using this equity beta. So we can say that when we say that equity beta reflects risk, it is actually the systematic risk that we are talking about. So equity beta shows systematic risk. Now systematic risk can further be divided into two risks: business risk and financial risk. We can split systematic risk into further two types of risks: business risk and financial risk. So my question to all of you is, who can explain the business risk? What is the business risk? Okay, none of you is wrong, but to make it simple, we can say that business risk is a risk that the business may fail to cover its operating costs, especially fixed costs. So if the sales volume of a company goes down to such a level that the company is not able to cover its operating costs, if the company feels that this may happen in the future, that's called business risk. The failure to cover the risk of failing to cover the operating costs is called business risk, and it usually arises because of fixed cost. Because when your sales volume goes down, your variable cost is also reduced. It's the only fixed cost that stays the same, and because of the fixed cost, you may suffer a loss. So that is called business risk. On the other hand, financial risk is the risk that the business may not be able to pay its debts on time when they fall due. So this clearly tells us that every company in a particular business will be facing business risk related to that business, but not every company will have the financial risk. It will only be a company that is geared, a company that has debts in its capital structure. It's only that company which faces the financial risk. So it goes without saying that only a company having debts in its capital structure will have financial risk. But business risk is a risk that will be faced by every company in that particular business, irrespective whether they have debts or they don't have debts. Business risk will be faced by all of them. But your equity beta reflects both types of risks, whether it's the financial risk or the business risk. So if the company feels that the demand may reduce, and because of the demand going down, it may not be able to recover its operating costs, then that's a business risk. And if it feels that it will further go down and it won't even be able to cover its financial, it may not be able to pay its debts on time, that's a financial risk. So equity beta shows both business risk and financial risk. There's another beta that we call asset beta. Asset beta just shows business risk. So we can say asset beta is part of equity beta. Asset beta shows business risk. It only shows business risk. Now, there is a relationship between asset beta and equity beta. And that relationship, let me show you. There's a relationship between asset beta and equity beta. Asset beta is equal to equity beta into equity divided by equity plus debts into 1 minus tax. So that's a relationship between asset beta and equity beta. So if you have equity beta of a company, especially a company that is geared company, a geared company is one which has debts, long-term debts in its capital structure. So if a company has long-term debts in its capital structure, it is called geared company. If a geared company's equity beta is given, it means that you know the total risk of that company, including the financial risk and business risk. Right? With help of one company's equity beta, you can find out equity beta of another company. But obviously, if there are two companies, remember, if there are two companies operating in the same business and they are almost similar, if two companies that are very similar and are operating in the same business, they both will have the same business risk because they are in the same business and they are very similar to each other. Though it's a very theoretical assumption that two companies will be exactly similar to each other. There will always be some differences between two companies. But theoretically speaking, if two companies they are very similar and they're operating in the same business, it goes without saying that they will have the same level of business risk. So their asset betas will be the same. Now, if the two companies they have different capital structures, for example, company A has 30% debts out of its total capital, whereas company B has 50% debts out of its total capital. It means they have two different capital structures. Now, if they have two different capital structures, they will have different level of financial risk. They will have different levels of financial risk because a highly geared company will have a high level of financial risk. A company that has lower level of debts will have a lower level of financial risk. So since equity beta shows both type of risks, therefore equity beta of one company will be different from equity beta of another company if they both have different gearing levels. So we cannot use equity beta of one company for another company, even these two companies are very much similar to each other, operating in the same business, but since they have different capital structures, we cannot use equity beta of one company for the other company. So we have to make some adjustments, and that's the adjustment which is required in this question as well. And now look at this question again. Two companies are identical in every respect except for their capital structures. Now they have different gearing ratios, but everything else is same. Now company XY has a debt to equity ratio of 1:3, which means that they have 3 times of equity as compared to their debts, and its equity beta value is 1.3. Now this equity beta of company XY not only shows the business risk of this company, but it also shows the financial risk of this company. Whereas PQ company has a debt to equity ratio of 2:3, which is different from XY company. Therefore, it will have a different financial risk. So we cannot use equity beta of XY company as an equity beta of PQ company. So what we have to do is we have to first convert this equity beta into asset beta so that it shows only the business risk. So I've just given you people this formula. Can you just take a minute and calculate asset beta with the help of this equity beta? You have 1 minute and calculate the asset beta of XY company using this formula. Yes, Fatima, you are right. If a company is completely ungeared, it does not have any debts, its equity beta and asset beta will obviously be same. So if we need to find out asset beta, it will be equal to equity beta, that's 1.3, into equity. Now, since it's the equity beta of XY company, we cannot use gearing ratio of any other company. We have to use the gearing ratio of the same company whose equity beta has been given. So we will be picking up equity of XYZ company. So equity is 3 times. So we can just pick 3 as equity, and we have to divide it by equity plus debt. So equity will remain the same as 3 and debt will be 1 as mentioned here. So debt will be 1, but we have to make it after tax. So the tax rate is 30%. So we have to multiply it by 70%. So do not forget to do this calculation of multiplying that 1, the debt, by 1 minus tax. So now it's 1.054. So anybody having a different answer, just check it what you actually did wrong. And it's always better to write equity beta or asset beta up to 2 decimal places. It's advisable to write it up to 2 decimal places. So it's 1.05. Now, this asset beta now shows only the business risk. That shows business risk only. The additional 0.25, I guess, yes, 0.25. The additional 0.25, which was there in the equity beta, was showing the financial risk of this company. Now we have actually offloaded the financial risk of XYZ company, and now it's a business. It shows a business risk. Now any company similar to XY company operating in the same business will have the same level of business risk. Do you people agree to this statement? Any company similar to XY company operating in the same business will have the same level of business risk as shown by asset beta. Do you people agree to this statement? Yes. So we can say this is asset beta of XY company, or we can also say that this is the asset beta of PQ company, as it's a similar company operating in the same business. So we can treat this asset beta as the asset beta of PQ company as well. But we cannot say it's the equity beta as well of PQ company. A PQ company is a geared company, though it has a different level of gearing, but it is a geared company. So this cannot be the equity beta of PQ company. This could have been the equity beta of PQ company had PQ company been ungeared company. That is, it was 100% equity financed. In that case, the same asset beta would have been treated as equity beta of PQ company, because it wouldn't have any financial risk. It wouldn't have any financial risk in that case. But in this particular case, since PQ company has debts, so there must be financial risk as well. So we have to recalculate the equity beta using the same formula. But this time we have asset beta, we don't have equity beta. So we have to calculate equity beta. So how do we do that? What was in the denominator should go to the numerator of the other side, and the equity will be going to the denominator side. But this time we have to use PQ's debt to equity ratio and not the XY's equity debt to equity ratio. So we'll be using this company's debt to equity ratio. So we are now calculating equity beta for PQ company. We'll just pick this asset beta into equity plus debt should be multiplied and equity should be divided. So equity plus debt, equity, what's the value of equity? It's 3 plus debt is 2 into 70% divided by equity, which is 3, 1.5455 times. That's the equity beta of PQ company. And you can clearly see that XY company had a lower level of equity beta than PQ company, and the obvious reason is it has more debts in its capital structure. If you just look at the ratio here, it's 1:3. That is $1 of debt against $3 of equity, whereas here the ratio is on the higher side, $2 of debts against $3 of equity. So it has a higher level of financial risk. That's why you can clearly see it has a higher value of equity beta. Is that clear? Okay, let's move towards another question. Okay, take a minute and solve this question. Noreen, do you see 33.33% as an option? I guess that's too much on the higher side, 33%. Okay, so it's basically a reverse calculation question where you have the cost of equity now, and we have to do some reverse calculation to find out the growth rate. So let us first write the formula of dividend growth model. It is if we talk about KE, it's going to be KE is equal to D naught, that's the latest dividend or current dividend, into 1 plus growth, which is required, divided by it's the market price per share, and it should always be X div, which is already X div. So market price per share plus growth. Now we need to find out the growth, right? So how do we do that? We have to put values first, and let's see. The value, the cost of equity is 10%, is equal to and let's subtract the, okay, let's write it with the help of a pen now. So cost of equity, which is 10%, is equal to D naught, which is the current dividend. The current dividend is $3. Okay, 3 into 1 plus G. We don't know the growth rate at the moment. The market price is, what's the market price? It's 40 plus growth. Now just expand it. Now we have to solve for G. Now those who haven't come up with the answer, can you try it again now? So one of the ways through which you can find out is to just simply put the values and see if we can get 10% at any of these growth rates, right? That is only possible when you have the options available, right? So, but the right way of doing it is to solve this equation. So let's take this 10% to the other side and this G to this side. Yes, it's 2.33%. I guessed it's 2.33% because if we just put 3 into 1 plus 2.33%, and divided by 40, and then we add the growth of 2.33%. So to check, cross check whether we get the 10% answer or not. So it's 10%. The cost of equity is 10%. If we put the growth rate of 2.33%, so that's the correct answer. That's the correct answer, 2.33%. And we can find out the same 2.33% by just arranging these values and find out G mathematically. So if we put 2.5%, we will be close, but not that close as we are in case of 2.33. It's 10.19%, so a bit far. Similarly, if you put 7.5%, we won't be even near to 10%. It's 15.56%. And if you just put 10%, again, it will be a different answer than the given cost of equity in the question. 18.25%. So if we put these three growth rates in the formula, we won't get cost of equity equal to 10%. It's only the 2.33% growth rate that will give us the same answer. Yeah, I'm solving the equation. I'm just showing you the trick in the exam, because that equation, solving the equation, will be slightly a lengthy work to do. So if we take this growth rate to the other side, it will be 10% minus growth is equal to 3. See, if you open the bracket, it will be 3 plus 3G, right, divided by 40. Now this 40 will be taken to the other side and multiplied with both the values. So if I take it to the side, 40 will be multiplied with both 10% and the G. So 40 into 10%, it will give us 4 plus, sorry, not plus, it will be minus 40G is equal to 3 plus 3G. So let's take this 40G to the other side and bring this 3 to this side of the equation. So it will be 40G plus 3G. I've just brought it to the other side. It was minus, so it's now plus. And take this 3, which is plus on this side, it should be taken to the other side. It will be 4 minus 3. So 40 plus 3, it's going to be 43G. 4 minus 3 will be 1, and 43 will be divided. So what will be the answer? 1 divided by 43. And if I convert it to percentage, it will be approximately 2.33%. So that was a bit lengthier for 2 marks question. I think it will be too lengthy to do this all stuff. It's better to, if you have all the options, so better to just put in the value and see if we can get that 10% answer. That will be much easier. Okay. Market rate of return is currently a question mark. So again, it's the CAPM model, where it is asking for a market return, right? So it has already calculated cost of equity. So we have to do that reverse calculation again. So the formula of cost of equity would be cost of equity is equal to risk-free return plus equity beta into market return, which is required, minus risk-free return, which is given. So this is what we need to find out. For that, first of all, we have to subtract risk-free return from the cost of equity. Cost of equity is 9% minus the risk-free return, which is 3%. So it's 6%. So we have done this. Now we have to divide the result of the difference of the two by the cost of equity divided by, sorry, cost of, not cost of equity, equity beta. We have to divide it by the equity beta, which is 1.2. Now that's 5%. So it is gone again. So now we are left with RM minus RF. Since we need to find out RM, so we have to add RF to the other side. RF is 3%. That's market return. So it's a simple mathematics. Okay, I'm giving you people a couple of minutes. Just go through this question and calculate the weighted average cost of capital. This is something we just did it when we started the session. So a good one for you to practice. Get a couple of minutes and solve it. Okay, let's just calculate weighted average cost of capital. But before we calculate the cost of capital, we need to know the different costs of different sources. And as I told you that whenever you get such type of a question, the very first thing that you need to do is to identify the sources of capital in the question. We have equity, which is always there. We have 7% preference shares, and we have 12% debt capital. So we have three sources in this question, and we need to find out the cost of these sources one by one, and then we need to find out the weighted average cost of capital. Um, for cost of equity, which formula we should be using in this question? May I know? What do you think? Which formula should be used? It's CAPM, right? Very good. It's a CAPM formula in this question. And we have a risk-free return of 12%. Quite a huge one. 12% plus equity beta. Do we have equity beta? Yeah, it's 0.9, 0.9 into market return, which is 18% minus 12%. So it's 17.4% the cost of equity. Okay, then we need to find out cost of debt of preference shares. Cost of debt of preference shares. Preference shares of $1 each, 20 million shares, market value 50. Preference shares and irredeemable long-term debt capital. So preference shares, they haven't mentioned anything about preference shares, so we have to assume that these are also irredeemable. So the rate is 7% and par value is $1. So 7% into $1. That's the per share dividend that we have to pay to our investors, and we need not to subtract any tax because dividends are not tax allowable expenditures, and divided by the market price. Market price is 50 pence. So it's 14%. Then comes cost of debt of debt capital. The percentage is 12% multiplied by the par value, and it says it has a $100 nominal value. Par value is $100, and it should be multiplied with 1 minus tax. The tax rate is 35%, so we should be taking 65%. And after doing this, we have to divide it by the market value, which is 80. So 9.75%. So here we got costs of individual sources, and then we need to pick up market values. Market value of equity, the total par value is 40. So they have already given us the number of shares, so we don't need to divide it with anything. So 40 million shares, which means 40,000 into $2 per share market value, so 80,000. And these figures are in thousands. Then we have preference shares. We have 20 million preference shares, 20,000 into 0.5. Then we have 20 million divided by 100 multiplied by 80, 16,000, and the total will be 106,000. Okay, now 17.4% of 80,000. 14% of 10,000 and 9.75% of 16,000. This is the total that we will be paying. So the WACC will be this divided by total market value and convert it into percentage format. So it's 15.92%. So KE is 23.4%. Is it 23.4%? How is it? It was risk-free, that is 12%, plus 0.9, that is equity beta, into market return, which is 18%, minus risk-free, which is 12%. So it's 17.4%. Okay. So back is 15.92%. So the rest of the questions are almost the same as we have done so far. So I'm just giving you people a break, and within the break you may go through these questions if you want to, or you may keep it for as your homework. And if in case there is any problem in any of these questions, you may ask me later on, or even if after the break you feel that you have attempted any of these questions and you still have any problems, you may ask me after the break. After the break, what my agenda will be to solve MCQs of business valuation. We'll be solving one CRQ, and we will also be solving one of the MTQs. So this is the today's agenda. We will be doing these in today's session, and in tomorrow's session we will be solving working capital questions and risk management questions. So we'll be practicing risk management and we'll be practicing working capital. So let's take a break, and within the break, if you want to solve these MCQs of cost of capital, you may. This break is going to be for 15 minutes this time. So it's 9:52 at my end. I don't know what time it is at your end. So right after 15 minutes, we will be back. Welcome back, guys. I hope you people may have tried few of the questions. If there is any question that you want to ask, you may ask. Otherwise, I'll be moving towards business valuation questions. Okay. Well, they've already mentioned it that on the assumption that the data for 2001 to 2005 provides the basis for estimating future trends. So obviously, we'll be using the 5 years growth rate and use it for the future dividends. So let us solve it. Now, what we have to do is we have to take per share dividend. Since the shares haven't changed as per the question, it was 2 million throughout these 5 years. So the earliest dividend, total dividend was 300,000 divided by 2 million. So it's $0.15 per share. That was the dividend 5 years ago. Not 5 years ago, it's 4 years ago, right? So 0.15. And then it was 379,000 divided by 2 million, 0.1895. Again, it was in dollars. So from 0.15 to 0.19, it has grown at a certain rate. What that rate is? Earliest dividend, latest dividend divided by earliest dividend, raised to the power the number of years between these two dividends. It's 4 years, because if you just count them from 2001 to 2002, it's 1 year, then 2, then 3, and then 4 years. So it was 4 years and minus 1. So the growth rate in the last 5 years was approximately 6%. Now let's apply the cost of equity formula. The latest dividend, which is 0.19, expected to grow at the rate of 6% in the future, divided by market price. The market price is 1.18. Then the growth rate again. So the answer is 23.04%. So it's 23%. Now, Rukaya asked me, that said my answer is 21.6. So I'm confused of whether I should be clicking on 21% or 22%. Obviously, Rukaya, if it was 21.6%, I don't think the examiner would have put you into this trouble of whether selecting 21 or 22. So if you ever get into this problem, remember one thing: either the answer will be in the whole numbers and you are getting it in points by error. It's an error. That's why you are getting it in points. Otherwise, examiner never gives two answers that are too close to each other. Okay, let's just move towards business valuation questions now. Okay, for business valuation, uh, I'm just telling you one thing, that if you remember this, you will always be able to find the right value for shares, for debts. Remember this thing. If you ever have to find out the value of shares or the value of any debt, it is always the present value that you have to calculate. It's always the present value that you have to calculate, simply. And present value of what? Present value of whatever future returns we expect from that instrument. Like if you have to find out the market value of shares, whatever we expect to receive in the future from that share, if you find out the value of that, it is the market value. Whatever interest or whatever cash inflow we expect from a debt instrument like loan note, debenture, or preference shares, if you find out the present value of those returns, that will be the market value. So all we have to do is to find out the present value of whatever we are going to receive against that instrument in the future. Like just look at this question. A company has made an issue of 8% convertible loan notes with 8% par, with a par value of $100. The stock can be redeemed in 4 years time at $130. So this is one of the payments that the investor is going to receive. And also the investor is going to receive 8% interest at the rate of or it can be converted in 4 years time into 40 shares, at which the falling share price would an investor not opt for redemption. So it's a bit a different question, and we don't need to find out the value of the loan note. It is something different. It's saying that at what price out of these the investor will choose to convert rather than redeem. Now, what does that mean? The company has issued loan notes, and upon issuing the loan notes, the company has given option to the investor whether the investor wants to convert these loan notes into ordinary shares of the company in 4 years time, or they may get their cash back. They may redeem it at $130 in 4 years times. So either the investors will get this cash value of $130, which we call redemption value, or they may convert loan notes into 40 ordinary shares of the company, right? So what the investor will be doing, the investor will be doing whatever he feels or she feels beneficial for him or her. So obviously, when the investor's decision will be based on comparison between redemption value and conversion value. Conversion value is basically the value of the shares, the value of those shares that will be available upon conversion, like 40 shares. But at the time of redemption, we're talking about at the time when these shares will be when the loan notes will be converted into these shares. At that time, what will be the value of these shares? That is called conversion value. Since we don't know that, and that's what they're asking for. Now you know that if the investor decides to redeem, investors will get $130 against each loan note. Now, what should the conversion value be at least, so that the investor is indifferent between the two? It should be $130. So if the conversion value, that is the value of the shares after 4 years, if it's the same as the redemption value, the investor will be indifferent. But in case conversion value is higher than the redemption value in 4 years time, the investor will convert rather than redeem. Or if the redemption value will be higher in 4 years time compared with the conversion value, then the investor will not convert, it will redeem. So let us calculate total values of let us calculate the value of these 40 shares using all these prices and see at what price the investor will choose not to redeem. So he will have 40 shares, and let us suppose that each share will have a value of $3. So in case the share price is going to be $3 after 4 years, the investor will get 40 shares which will have a value of 120. Now tell me, if you are the investor, will you choose to redeem and get $130, or will you choose to convert and get a shares worth of $120? Obviously we will be redeeming. So that's not the price. That's not the price he's looking for. Similarly, if that's not the price, 2 cannot be the price. 2 is lower than 3. So 2 can't be the price. 3.5 might be the price, but 2.5 can't be the price because it's again lower than 3. So it's probably going to be $3.5, but let us calculate. Let us calculate. Instead of using 3, let's calculate 3.5. If the price of the share in 4 years' time will be $3.5, the conversion value will be $140, and the investor will not choose to redeem. He will rather choose to convert. That's the answer. $3.5 is the answer. Using the net asset basis of valuation, what is the value of an ordinary share? We have to find out the value of one share. So these values are in total, and we have to divide it by the number of shares. But before that, we have to find out the value of equity. So the value of equity currently is, ordinary shares of 125 and reserves of 500. So 125 plus 500. That's the total value of equity using book values. But remember, for financial management, if you find we are looking for valuation of the company using book values, we never include goodwill. We never include goodwill as value of the company, because the value of the goodwill will be decided through negotiations when we sit on the table with the seller of the company, with the company owners, the existing owners of the company. We cannot take their value as the goodwill of the company, because that's what they think it's the value. So we won't go into the subjective thing. So we'll be picking up tangible assets. Like, so from 525 we have to subtract 150. Simple. So 475 will be the total value, and that's in millions, and we have to divide it by the number of shares. The number of shares will be, it's $1 share, so 125 million shares. So the value of the share is $3.8. For financial management, remember, for financial management, we never consider preference shares as part of equity, even if it's irredeemable. Whether redeemable or irredeemable, we treat preference shares as debts. And we have subtracted goodwill because goodwill of a company is always very subjective. If somebody says that we have a goodwill of 150, will we purchase it at whatever price? or whatever, will we accept that goodwill value straight away? No, it's a very subjective thing. So for business valuation purpose, we never include goodwill as part of the value of the company. Yes, we may pay more than the value of the tangible assets or non-current intangible or tangible assets. We may pay more than that, but that value cannot be picked from the books. That's something that we may calculate ourselves when we are quoting for a company, but we cannot straight away pick it from the balance sheet and put it as a value of the company. What, according to the theory of shares value, the theory of shares value, when they say theory of the shares value, that they mean traditional theory. And traditional theory about shares valuation is the dividend valuation model, which values the shares on the basis of the future dividends, the market value of the company to the nearest $1,000. Okay. Um, we need to use dividend growth model to predict the value of the company, but we don't have growth in the question, but we have to find out the growth. Now for growth, one formula of calculating growth is the compound growth rate, which we discussed earlier on. The other formula is the Gordon's growth approximation model, which is equal to B into R, that is retention ratio and the rate of return on equity. So retention ratio, earnings retained and invested 60%, that's a retention ratio, is the reverse of dividend payout ratio. So if a company has a retention ratio of 60%, it means it has a dividend payout ratio of 40%. So sometimes the examiner may directly give you the retention ratio, that is 60% in this case, or it may give you the dividend payout ratio. Like if the question has given us the dividend payout ratio of 40%, in order to calculate the retention ratio, we will be subtracting the dividend payout ratio from 100. So 100 minus 40, 60%. In this case, we don't need to do it because it is the retention ratio, 60%, and the return on equity or return on investment is 15%. So the expected growth rate in the dividends will be 9% in this case. And let us now find out the value of equity. First, let's find out the value of, okay, since the question has given us the total dividends, if we put the total dividends in our formula, we will get the total value of equity. But if we put dividend per share in the formula, we will get price per share. Since we have to find out the value of the company, that is the value of equity in total, so we don't need to convert this into per share. Let's straight away put it into the formula. Dividends into 1 plus growth, which is 9%, divided by cost of equity, which is 20%, minus the growth, 9%. That's the dividend growth model for calculating the market price per share. But since we have put total dividends, therefore it will not be giving us per share value, it will be giving us the total value of equity. And that's 1783636. And if we round it off, in thousands, it will be 1784000. That's the answer. That's 9%. It's a Gordon growth approximation model, B into R, where we need retention ratio, that is how much of the profits we are retaining during the year. Obviously, if we are retaining it, we will be reinvesting it. And if we will be reinvesting it, we will be having additional returns. And if we are getting additional returns, we will be getting additional dividends. So there will be a growth in dividends, which will be equal to how much we are investing into, at what rate we are earning. So 60% into 15%, the growth in the dividends will be 9%. And that is because we will be retaining 60% and earning 15% out on these reinvestments. Okay, just solve this question. Asad, if a company invests retains 60% of its profits, 60% of its profits, obviously the company will be retaining to reinvest. So 60% of the profits will be reinvested, right? And these 60% will be invested at a rate of 15%. So how much additional we will be getting? 15% of this 60%. It's 9%. So it means we will be increasing our profits by 9%, which in return will increase our dividends by 9%. And that's the growth rate. Is it clear? Yes, yes, this has been rounded off because if you look at the answers, all of these figures are in thousands. Okay, a core company pays dividend annually. It has just paid a dividend of 40 cents and has a policy of increasing the dividends each year. The company is all equity finance and raises new capital for investment from retained earnings. The company retains 50% of its earnings and invests these at a return of 12%. Okay, again, we have to use Gordon growth approximation model to find out the growth, and it's easy. 50% into 12%. It's 6%. Now, market price per share will be equal to dividend just paid, 40 cents. Since I'm putting cents, I'll be getting answer in cents as well. Into 1 plus growth rate divided by cost of equity, which is 12%. They've said cost of capital. Rather, they should have said cost of equity. But since it's an all equity finance company, so it doesn't matter. When it's all equity finance company, the cost of capital will be equal to cost of equity. But make sure that if cost of capital and cost of equity both are given, we will be using cost of equity only. Cost of equity minus the growth rate. It's 707 cents, and this is what we have to answer it in cents as well. So we'll just write 707 cents. Obviously, you will be marked wrong because they have asked the answer in cents, and it's a fill in the blank. So if you write it 7.07, obviously it's not going to be the answer. It's $7.7. So you should be very accurate when it comes to fill in the blanks. Okay, which is the most realistic basis for valuing an asset that is to continue to be used in a business? Okay, what do you think? Which of these four will be the most realistic basis for valuing assets that will be used in the business? Okay, historic cost adjusted for depreciation basis, it is something that we use for reporting purpose, not for valuation purpose. It's always the replacement basis that we use for valuing assets that we intend to use in the business, and we're not selling it. Because for business valuation, historic values of the assets, they do not give realistic values. They're just historic values, and since we might be planning to buy the business at the moment, so we are not interested in at what price or cost these assets were bought years ago. So when the assets are supposed to be sold and not used in the business, they are acquired at their realizable values. But if the assets are of such nature that they will be uh, used in the future as well, they are never sold on realizable value basis. They are always valued at their replacement cost basis. That means how much it will cost them, how much it will cost to replace them. Like for example, if you just had a flooring at your home, you have what you call a wooden flooring. You had wooden flooring at your home just a month ago. So obviously, if you just try to find out their the wooden floors realizable value, you won't be able to realize much. It will be considered second hand and won't have that value. But you will never want to sell. So if at that point you want to sell your house in which you just had these uh, wooden flooring, you will never uh, add the realizable values of these wooden floors. You will just simply value them at their replacement cost. That means if the same wooden flooring is done today, how much it will cost. That will be considered as the value of that wooden flooring, and not the value at which these wooden floors will be sold, because they won't realize much. How I hope you people have got this point. Okay, now we have market efficiency, right? Market efficiency. Let me give you a quick concept of what market efficiency is. Uh, Market efficiency is basically the efficiency of the market in responding to a new piece of information. Let me give you an example. You saw an ad where a person is selling his car. In his ad, he has mentioned the condition of the car, the features, everything. And based on that information, you have made up your mind to buy that car, let's say, for for 10,000 US dollars, right? You've made up your mind to buy that car for 10,000 US dollars, and that's the value in your mind, and you're ready to buy that car for $10,000. And you just left your house, and you're now moving towards that person who's selling his car. And when you left your home, at that time, the car was in the condition as mentioned, but while you were on your way to that person, um, that car got a minor accident, right? And you you still don't know, since you are on your way to that person, you don't know exactly that the car had now an accident. So do you think the value in your mind will now change, because since you don't have the information now? So what do you think? Will you still be having the same value in your mind, $10,000. You don't know about that accident at the moment, so you will have the same value in your mind, or it would have changed. It would be the same, right? Because you don't know about that minor accident. But the moment you come to know about that accident, what do you expect the new value to be? More, a higher one, a lower one, on this, or the same one? Yes, lower. The similar mechanism works in stock market as well. When the investors in the stock market, they get a new piece of information, if they get new piece of information, they will respond accordingly. And the prices in the stock market, because of the response of the investors, will change. And that response is because of the piece of information that they're getting. So stock market efficiency, or efficient market hypothesis, basically is basically a theory which says that whenever a new piece of information is received in a market, the share price will change based on that information. And efficiency is how quickly stock market responds to a piece of information and reflects it into the share price. That's called efficiency of stock market. And there are three levels of a stock market's efficiency. Number one, the weak form of efficiency. In the weak form of efficiency, which is a very theoretical form, which does not exist in practice, but still, theoretically speaking, a weak form of efficiency is one in which stock market only responds to, to a piece of information when that event occurs. That is when it becomes history. That means only historic information is reflected in the in the share prices. Now, why it is not practical to assume a stock market to be having such level of efficiency? You know what does this imply? It means that the investors in the stock market will only respond to historic events, and they do not have access to publicly available information, whereas the whole world knows about something that is going to happen in the future. Everybody knows, the information is public, it has been made public, but it's only the stock market players, it's only the stock market investors who don't know about that information. I don't think this is rational to think that everybody else in the world knows about something, and the stock market or the investors in the stock market, they don't know about it, and they're not responding to that information. Since that information is related to future, even if it's publicly available, stock market is not responding to that information. It's not possible. If anything is made public, if any information that is available publicly, the investors in the stock market will also know about it, and stock market prices will always reflect that information as well. But in the weak form, they assume that stock market will not reflect any future information, even if it's publicly available. The stock market will only reflect information that is related to past. Let me give you an example. Company A has announced publicly that it is going to acquire company B. The deal has been locked. It's only the matter of time when they will be actually acquiring that company. They have already decided. They have made this information public. Now, weak form efficiency would suggest that the stock market investors, they don't know about this. Even if the whole public knows, they don't know about it. That's why they haven't responded to this information yet. And the share price currently does not show this information. It does not reflect this information. The share price is still the same as it was before this information was made public. It's still the same. Do you really think it's possible? If company A has announced that it is going to acquire company B, and if that decision is a favorable decision, the company A's shares prices are expected to go up. But in the weak form, it won't be reflected and the share price will remain the same. So that's called weak form of efficiency. Semi-strong form of efficiency is when stock market not only reflects the historic information, but it also reflects publicly available information. Like in this case, as I just told you, that if company A has decided and announced that it is going to acquire company B, and if that information is favorable, the moment this information is made public, even if the company hasn't been acquired, but the information has been made public, the investors will respond, the demand of the shares will increase, and the price will go up immediately. Information is released. So later on, anyone with this information, or even if this merger occurs later on, if this merger occurs later on, there will be no change. Theoretically speaking, there will be no change to the price, as the price would have already adjusted the time when this information was made public. Weak form of market and inefficient markets are the same. Yes, you can say they are the same. And strong form efficiency is one in which stock market not only reflects historic publicly made available information, but it also reflects future information. That is information which hasn't been made public, even if it reflects that information. And that's called insider dealing. It means that the directors of a company have decided to acquire another company. They haven't made this information public, but still stock market comes to know about this information, even if that information hasn't been made public. So it means somebody within that meeting is responding and buying the shares in the market or spreading this news in the market, and the stock market is responding to this piece of information when even if it's not made public. It is called insider dealing, and it is the illegal form of stock market. That's called strong form efficiency. So there are three levels of efficiencies. Now, totally inefficient or weak in a weak form, I think uh, it will be the same. I don't think that there's going to be another level below weak form efficiency. I mean, if it means totally inefficient would mean that stock market will not react to any sort of information. That may be a totally inefficient stock market. That means even if something happens, the stock market won't respond to it. I don't think that this is something that we should even be assuming. It's totally irrational to believe so, that the stock market will not at all respond to any information. Okay, let's go through this question and let me know what's the answer. Pandy Zinc Company is financed entirely by issue share capital of 8 million ordinary shares of 50 cents each nominal value. Their market price is currently $1.5 per share just prior to a 1 for 4 right issue at $1 per share. The finance raised will be invested immediately in a project that has an expected net present value of $3 million. What are the best estimates of likely share price after the right issue if the market shows weak form efficiency and strong form efficiency with expected net present value of the project known and believed by investors? Okay. So in the first part, weak form means only historic information will be reflected. Since the finance has been raised, but the expected NPV, since it's related to the future, it's a future information, and in a weak form efficiency, it will never be reflected. But since the right issue has been taken place, that's what it says. So we have to in the weak form, the share price will be the theoretical X-right price. So the existing price is 1.5 into 4 plus 1 new share into 1. So, and then it should be divided by 5. So $1.4 will be the share price after right issue. So even if it's a weak form efficiency, the price will be $1.4 as right issue is an historic information. Whereas the expected net present value is a future information. So in the first part, that is the weak form efficiency, it won't be reflected in this price. Now let's talk about the second one, strong form. In the strong form, even the expected net present value will be reflected in the share price. Now expected net present value is $3 million, and the total number of shares will now be the new shares issued and the existing shares. So new shares will be equal to 1 for 4 right issue, right? So it will be 8 million into 1 divided by 4. So the new shares will be 2 million. The existing shares are 8 million. The total shares will now be 10 million. It will be 10 million. So the total value of the company will now be the existing value, which is 8 million shares into 1.5 plus the new shares into $1 because new shares have been issued at $1 plus the net present value, which is 3 million. So the total value of equity will be existing shares into existing value plus new shares into the exercise price of the new shares plus the 3 million of NPV. The total value will be 17 million, and it will now be divided by 10 million. So it's going to be 1.7. So the expected share price in the stock market will be $1.7 if the stock market is showing strong form of efficiency. $1.7. So the answer is A. 1.5 in case, sorry, not A, it's B. Uh, in the weak form, it will be 1.4, and in the strong form, it will be 1.7. That's the answer. Mahin, sorry, Mahin, I'll get back to your answer, Mahin. Hamad, 1.5 is just before the right issue, right? But they're asking that what will be the price after right issue. That means that when after the right issue has taken place, what is supposed to be the price? So it means they're assuming that right issue is an historic event, and in a weak form, that historic event should be reflected in the stock in the price. Okay, now Mahin has asked a question: what is meant by market paradox? Paradox. First of all, you need to understand what is meant by paradox. Uh, Paradox is a statement uh, that when you read a statement and that statement contradicts itself, but still it is true to believe in it. It's such a statement is called paradox. Like let me give you an example of a paradox will be mm, what could be best example for paradox. Like I just um, searched an example of a paradox. For example, the example is walking is dreaming. Right now, when you're walking, how come it can be a dreaming? So but someone can say that when I walk it seems like I'm dreaming. So it can't be it's not possible that you will be walking and at the same time you will be dreaming. But for someone it may be like a dream, walking. uh, so this type of statements which when you read in the first place you may not believe in it. It will be somewhat contradicting, but still if you read it thoroughly you may feel that yes, it's possible, yeah, or it's true. Yeah, like Fatima has come up with a very good example: saving money by spending it. Now people may believe, may just after just reading it once, you may be saying that how insane it is to believe that when you spend it you are actually saving it. But if you just go through it again and again, you will understand the meaning of this statement, which apparently seems to be contradicting, but still if you look at it, it may hold true. Like it means spending means saving means you are investing, like maybe like many people here in Pakistan. If I talk about in Pakistan, they bought cars years ago, and years ago people, not every car would have made profit when they are resold, but people who bought cars here in Pakistan 3 years or 4 years or 5 years back, and now when they're selling these their second-hand cars, they're actually making profits. Even after driving the car for 5 years, they're still making profits from their cars. So at that point of time, they may have called it expenditure. They may have called it that they've spent something, and probably they were expecting that when they will be selling their cars, they will be selling at loss. But okay, fine enough. They would have driven their car for 5 years as well. But instead of selling their cars at loss, they've actually earned. So by this statement, whoever has made this statement means that if you spend wisely, you may earn. So apparently it was contradicting, but it is making sense. So that such type of statements are called paradox. Similarly, market paradox would mean that you make a statement about market, you may make a statement about market behavior, and which the statement itself, if you read that statement itself, you may get the first impression you may get will be that how is it possible. But if you just thoroughly analyze it, you may feel that the statement is true about the market behavior. Like like one statement that Fatma just mentioned, save money by spending it. It's again, you can call it as a market paradox as well, because this is also telling you about some behavior about the market. Um, so market paradox is not a concept of financial management. It's just a term to explain that there are certain behaviors in the market which is abnormal, which is irrational. Let me give an example that um, wait, let me give you an example with figures. This- Um, what would be an appropriate example of certain market paradox? Okay, let me think about an example of another statement like this one, and I'll get back to this in a while if I get an appropriate example to understand to explain market paradox. Let us first go through the CRQ, and while we'll be solving CRQ, I'll just think about another example of market paradox. Okay, we have a question. This is a past exam question, card company. And in this example, in this question, we have to find out cost of equity using the dividend growth model. Then there is a discussion whether dividend growth model or capital asset pricing model would be used. Third is again a calculation. Calculate the weighted average after-tax cost of capital of card company using cost of equity of 12%. Calculate a project-specific cost of equity for card company for the planned joint venture. And then there's another discussion whether changing the capital structure of a company can lead to a reduction in its cost of capital and hence to an increase in the value of company. So first of all, let's calculate the cost of equity using the dividend growth model. So for that, we need to know the growth rate, the latest dividend, and we should have the market price, ex-div market price as well. So market price per share, ex-div market price share is given in the question. It's $7.16. Then we need to know the current dividend. A dividend of 62 cents per share for 2013 has just been paid. That's the current dividend. Current DPS is 62 cents. And we need growth rate. Now growth rate is not given in the question, and we have to calculate the growth rate. And as I told you earlier, that we have two models to calculate growth rate. One is the compound growth rate, and the other is Gordon growth approximation model. So here we have to use the compound growth rate, as we are being provided with the historic dividends from 2010 to 2013. So the latest dividend is 62 cents. The earliest dividend is 55.1, and we have 1, 2, 3 years in between. So the growth rate, the historic growth rate will be 4.01%. That's the historic growth rate. Now, one thing that you people should remember is that we only use historic growth rate in case we do not have any expected growth rate in the question. If the question clearly gives us the future growth rate, the expected growth rate, we should be using that growth rate. But in case we do not have any future growth rate in the question, we should be calculating the historic growth rate and assuming that the dividends will grow at the same rate as it has grown over last few years. Now the cost of equity will be equal to the recent dividend into 1 plus growth divided by the market price. The market price is in dollars, whereas the dividend that we have put is in cents. So we have to change this market price in cents as well. So we will write 7.16 into 100 in order to convert it into cents. And then we need to have growth rate at the end. Let me convert it into cents here so that we don't have complications in the formula. So cost of equity is 13.02%. That's the first part. Then the second part is the discussion of whether dividend growth model or capital asset pricing model should be used. Now, it's basically the topic. This question is all about comparison between the dividend growth model and CAPM model, and then we have to reach to a conclusion of as to which model should be used. So, how do we explain it? Dividend growth model only takes dividends into consideration and ignores capital gains. It also fails to incorporate project specific risk, and therefore can be used where the new project has similar risk to company's existing risk. It also assumes historic growth rate to be the future growth rate, which seems to be unrealistic assumption. On the other hand, CAPM model incorporates capital gain and also incorporates project specific risk through equity beta. It's more appropriate to use CAPM model for calculating cost of equity because of above factors, but it also depends on risk-free return, equity beta, and market return. The accuracy of these variables is very important, but is very important in predicting the correct cost of equity. That's it. So basically, when you get this type of a comparison or discussion, it's actually the comparison of the two models. So when you're comparing the two models, you are actually supposed to write their limitations. And if it's a discussion, then it uh, uh, should be uh, should be indicating towards a relatively better model. So your answer should be drafted in such a way that when you end your discussion, the reader should be able to find out a relatively better option. Is it clear? Okay. Let's move towards the third one. Calculate the weighted average cost of capital of card company using a cost of equity of 12%. So now we have to use cost of capital as 12%. So cost of equity of 12%. And in order to calculate the cost of capital, we need to have cost of debts. So let's look at the question and see what source of debts do we have, what type of debts do we have. Card company also has an issue in issue 8.5% bonds redeemable in 5 years time with a total nominal value of $5 million. The market value of each $100 bond is 103.42. Redemption will be at the nominal value, and we have to find out the cost of debt of this of bonds. And since its market value is 103.42, whereas the redemption value is the nominal value, that is $100. So whenever there is a difference between the market value and the redemption value, we have to use that IRR method to find out the cost of debt. So here's particulars, cash flows, discount factor, and annuity factor, and then present value. So at 0.0, the debt will be issued at 101 103.2, and sorry, particular is the market value, and the discount factor will be 1 and should be multiplied. So we got present value. Now the debt is going to be redeemed in 5 years time, which means that from year 1 to year 5 we will be paying interest, and the rate of interest is 8.5%. 8.5% into $100 into 1 minus tax. Tax is 30%. So that's the amount of interest that we'll be receiving from year 1 to year 5, and the annuity factor will be 1 minus 1 plus. We have to assume a rate in order to get a positive NPV, and let me assume a rate of say 5% raised to the power minus 5 divided by 5%. And then after 5 years we'll be receiving redemption value, which is going to be equal to par value, which is $100. And here we have to use discount factor 1.05 raised to the power minus 5. Let's find out the present values and the net present value. Okay, I'm already getting it very close to 0. So 5% could be assumed as IRR or cost of debt, but let us assume a lower value of interest so that we get a reasonably positive value. $5.48, and then again let us calculate another NPV, which should be negative, and let me copy this formula here, and let us take a higher value, say 7%. Negative NPV now, and the cost of debt will be equal to the lower rate, it is 4%, plus the positive NPV 5.48 divided by the positive NPV and minus negative NPV into 7% minus 4%. So cost of debt is 5.27%. Now we need to find out the cost of capital. We know the cost of equity, which is 12%. We know the cost of debt, which is 5.27%. Now we need to know the gearing. The gearing ratio. And the gearing ratio, the company, the proxy company has an equity beta. Card company is planning to invest in a significant, what's the ratio? The value of equity is 8 million shares into 7.16, and the bonds have a market value of 103.42, and they have 5 million worth of bonds. So cost of equity is 12%, and now we need to get the market values. Shares are 8 million shares at the rate of 7.16 8 million shares into 7.16 is the total market value of equity, and 5 million nominal shares, 5 nominal value, 5 million divided by 100 into market value, which is 103.42. Okay, it was 103.42. Now multiply the values with the costs and add the total values. Add the total values, and back will be 7143 divided by 62451. It's 11.44%. That's the weighted average cost of capital. Okay, we'll just solve this last one, but I guess the time is over. It's 11:32. So if you can just solve the D and E part, do the D and E part at home, and I'll be explaining it tomorrow. We'll start with these two areas tomorrow, and we will also solve MTQ along with the working capital and risk management questions. So ending the session for now, and see you people tomorrow with working capital and risk management questions. Bye, have a good day.